ACM Research beat consensus across the board for Q2 2026. I mean, revenue hit $292.9 million.
Right, which is a 36% year-over-year increase.
Exactly. Beating Wall Street estimates by over $18 million. And on the bottom line, non-GAAP earnings per share came in at 61 cents.
Crushing the estimates, honestly.
Yeah, totally crushing them. They were sitting around, just under 34, $2.42.
Yeah, right in that range.
And guidance was raised as well. Management lifted the floor of their full year 2026 revenue guidance to a range of $1.125 billion to $1.175 billion.
Which implies a 25% to 30% growth rate.
So naturally, shares jumped over 15% in pre-market trading on the news. They ultimately closed the day up 6.1% at $83.80.
That is just a striking headline print. I mean, beating top-line estimates by nearly 9% in this macroeconomic environment, it grabs your attention immediately.
Oh, absolutely.
Because retail investors looking at the semiconductor equipment space right now, they are hyper-focused on who is actually shipping tools and who is just, issuing optimistic forecasts.
Right.
And today's numbers put ACMR firmly in that former category.
So based on this Q2 earnings report, the analyst notes, and executive commentary, the mission for today's deep dive is pretty clear.
Figuring out the pivot.
Exactly. If you're looking at your portfolio right now, the central question you have to ask is how a company is pivoting its entire product line in the middle of severe international semiconductor trade restrictions and somehow still raising its long-term revenue targets to $4 billion.
That is the core tension of this entire report. We have this incredible operational execution happening, simultaneously with glaring geopolitical risks.
Yeah, and we'll get into those risks. But let's start with the immediate numbers, because a really glaring discrepancy jumped out at me regarding their profitability.
The GAAP versus non-GAAP split.
Yes. They reported a GAAP diluted EPS of $1.23, but the non-GAAP EPS is exactly half that, at $7.61. So why is the headline GAAP number literally double the adjusted figure?
Well, it really comes down to a significant paper gain rather than, actual cash generated from selling equipment. That GAAP number was heavily distorted by a $69.6 million unrealized investment gain from their principal operating subsidiary, ACM Shanghai.
Ah, got it.
Because of their corporate structure, the value of those investments is marked to market quarterly.
Meaning, as the value of the underlying equity fluctuates in the open market, they just have to record those swings on their income statement.
Exactly, even if they haven't actually sold the shares.
Right.
So the mechanics of it mean that while it looks incredible on a GAAP basis, it doesn't actually reflect the core business of building and selling semiconductor tools.
Which is what we actually care about.
Right. When you strip that $69.6 million away and you factor out standard stock-based comp, that $1.61 non-GAAP figure is the true operational metric for retail investors to focus on.
Which, to be fair, is still a substantial beat compared to that $1.34 consensus.
It's math.
So the core operations are performing well. But looking at the segment breakdown, I noticed a really surprising drag. For a company that, made its name in specialized wet cleaning equipment, their bread and butter products seem to be taking a hit.
Yeah, the legacy segment did decline.
Quite a bit, right?
We are talking about their single wafer cleaning tools, their Tahoe systems, which, combine bench and single wafer cleaning, and their semi-critical cleaning equipment.
Right.
That entire category dropped by 14.2% year over year.
Wow.
Yeah, landing at $133 million.
Usually, seeing your core legacy segment drop by 14% sends a stock completely plummeting.
Oh, almost always.
But the top-line beat here was rescued entirely by their newer segments. Like the category containing ECP, electrochemical plating, along with furnace and other technologies didn't just grow. It skyrocketed 167.7% to $128.5 million.
It completely offset the legacy drop.
Plus, advanced packaging and services jumped 153.3% to $31.4 million. Oh, and they also announced shipping their 2000th ECP chamber this quarter.
Hitting that 2,000 chamber milestone, that is a major validation signal from the broader market.
So for the listener who isn't, building microchips in their garage, what exactly is an electrochemical plating chamber? And why is every chipmaker suddenly clamoring for them?
Okay, think about how the entire industry is transitioning to AI chips and 2.5D packaging.
Right.
You can't just keep shrinking transistors on a flat surface anymore. The physics are literally maxing out.
We're hitting the atomic limit.
Exactly. So engineers are stacking chips vertically and placing them side by side on these advanced interposers. But to make that actually work, you have to connect all the stacked components so they can talk to each other at lightning speed.
It's like wiring the plumbing and electricity into a high-rise building instead of just a single-story house.
That is a great way to visualize it. Electrochemical plating is how you deposit these microscopic layers of copper to create those intricate interconnects.
Uh,
High bandwidth memory, which is totally critical for AI processors, relies heavily on this. So the demand for these tools is being aggressively driven by those advanced packaging investments. And ACMR is clearly capturing that wave.
So looking at these shifting revenue streams, it feels like ACM Research is successfully executing a pivot in plain sight.
They really are.
Like they are transitioning from this niche wet cleaning specialist into a much broader semiconductor equipment platform right before our eyes.
And management has actually formalized this transition. They operate on 3 stated strategic pillars, and the one applying directly to what we're seeing right now is product platformization.
Product platformization, got it.
Yeah, and this quarter proves the strategy isn't just, a slide in an investor presentation. The surging demand for their new copper plating tools and furnaces is completely offsetting the double-digit declines in their legacy cleaning equipment.
But that brings up a really interesting contradiction regarding their profitability. Well, when you scale up brand new hardware, it doesn't come cheap. R&D costs, prototype deployment, supply chain adjustments, it all eats into margins. And we did see gross margin compress this quarter.
We did, yeah.
GAAP gross margin fell to 46.0% from 48.5% a year ago, and non-GAAP showed a similar drop. Management explicitly blamed this on the product mix shift.
Which is standard. New product categories almost always carry lower gross margins initially compared to mature products that have had, years and years of cost optimization.
But here's where I am confused. If their gross margins shrank because they are selling less profitable, newer tools, how on earth does their operating profits go up?
That's the operating leverage kicking in.
Because the report shows GAAP operating margin rose from 14.7% to 17.0%, and non-GAAP held really strong at 19.2%. Mathematically, how does that even work?
The secret there lies in their operating expenses. OpEx actually dropped from 33.8% of revenue down to 29.0%.
Wait, so they are essentially sacrificing a bit of gross margin to grab market share in these new product categories like ECP and furnace, but they're relying on operational scale to protect the bottom line.
That is exactly the dynamic at play. It's a classic lesson in operating leverage.
Break that down for us.
Imagine opening a giant manufacturing facility. Your fixed costs, the rent, the utility bills, the base salaries for your management team, they cost roughly the same whether you build 10 machines or 1,000 machines.
Right.
Right now, ACMR is pushing so many of these new ECP machines and furnaces out the door that those fixed costs are shrinking as a percentage of every dollar they make.
Okay, so even if they make slightly less profit on the individual machine itself, the sheer volume of machines flowing through the factory more than makes up for it on the operating line.
Precisely. More of every incremental revenue dollar flows straight through to operating profit.
Which is what investors want to see.
Exactly. And despite the compression down to 46.0%, that gross margin is still safely above the midpoint of management's long-term target model.
What's the target?
They've guided for gross margins to sit between 42.0% and 48.0% for the foreseeable future. So landing at 46%, while aggressively scaling new product lines, it demonstrates strict cost discipline.
They aren't just giving the equipment away to win business.
No, they're managing the transition profitably.
But if they are sacrificing gross margins to rapidly scale these new technologies, that has to be burning cash. Do they have the runway to sustain this aggressive market grab?
They seem to think so.
Because management's forward-looking commentary is not shy at all. CEO David Wang declared 2026 a big year for new products, citing ramps across SPM cleaning, track, PCVD, and horizontal panel-level plating.
And breaking into those specific categories is incredibly capital-intensive.
Especially track and PCV, right?
Absolutely. Take track systems and PCVD. Track equipment handles the coating and developing of photoresist material during lithography.
Right.
And PCVD, plasma-enhanced chemical vapor deposition, is used to deposit ultra-thin films onto the wafer. You are going up against entrenched dominant incumbents in those spaces.
It's not a market you just casually enter.
No, developing a PCVD tool takes years of R&D and millions of dollars in prototype deployments before a fab manager will even consider signing a purchase order.
And management also highlighted a really healthy backdrop for wafer fabrication equipment, or WFE, spending in China. They're aiming to outpace the broader China WFE market growth.
Which is ambitious.
Very. They even reiterated a long-term revenue target of $4 billion. Just to put that in perspective for you, they just raised their 2026 full-year guidance to a midpoint of $1.15 billion.
So they are telling the street they plan to nearly quadruple their current annual revenue.
Which brings us back to my question about runway. Achieving a $4 billion revenue run rate requires phenomenal financial stability to outlast the evaluation cycles of these massive clients.
And looking at the balance sheet, they seem to have prepared for this.
Yeah, I saw they reported $1.36 billion in cash and short-term deposits.
Right, and if you strip out their borrowings, that translates to roughly $1.0 billion in net cash.
Having $1 billion in net cash provides a serious war chest. It lets them absorb those higher R&D costs and aggressively push these PKVD and track systems into commercialization without needing to tap the debt markets at current interest rates.
The balance sheet is a fortress right now.
Yeah.
And in the semiconductor equipment industry, capital intensity is a very high barrier to entry.
Right.
That net cash position is exactly what allows them to confidently forecast a $4 billion target. It basically buys them the time required to prove their new tools work in high-volume manufacturing environments.
Okay, so we've covered the top-line beat, the platform pivot, the operating leverage, and the fortress balance sheet. But we need to pivot from that bullish $4 billion target to the fundamental risks that could derail this entire trajectory.
Yes, we do.
Because you just cannot analyze ACMR without staring directly at their concentration risk.
The geographical and customer concentration here is extreme.
Substantially all of ACMR's revenue is derived from mainland China. Looking at the Q2 breakdown, just 3 customers accounted for 43.5% of their total revenue.
It's heavily concentrated.
And even more alarming, as of June 30th, 4 customers represent 52.4% of their total accounts receivable.
Over half of the money they are currently owed is tied up with just 4 entities.
Wow.
In a heavy CapEx industry like this, that level of accounts receivable concentration is a major vulnerability.
And management's own raised guidance explicitly hinges on their assessments of, quote, continuing impact from international trade policy and supply chain constraints. So I have to push back on the bullish narrative here.
Fair enough.
Can a company truly achieve a $4 billion long-term revenue target when half its revenue is tied up with 3 or 4 customers in a region facing the heaviest international semiconductor trade restrictions on the planet?
I mean, that is the single biggest existential risk for the stock. Retail investors have to weigh the impressive operational leverage we just discussed against the very stark reality of international trade policy. Because the mechanics of these trade restrictions are highly specific. The U.S. and its allies frequently update export controls based on specific nanometer thresholds for wafer fabrication equipment.
Meaning, if a Chinese fab is trying to build chips below a certain size, say 14 nanometers or smaller, Western companies are restricted from selling them the tools to do it.
Correct. Now, ACMR operates heavily within China, but they still rely on a global supply chain for parts.
Right. They don't make everything in a vacuum.
Exactly. If new trade restrictions block a specific component, say a specialized valve or sensor that ACMR needs to build its new ECP tools, that 25% to 30% growth rate can just evaporate overnight.
Wow.
Furthermore, if one of those 4 major customers faces direct sanctions and has to halt their own expansion, ACMR's revenue pipeline takes an immediate, highly concentrated hit.
And management seems acutely aware of this risk, even if they sort of buried in the footnotes of the press release. We talked about their product platformization pillar earlier. Well, their third strategic pillar is explicitly named customer globalization.
They recognize that reaching $4 billion while relying almost entirely on domestic Chinese fabs is a really precarious path.
So they have to look outward.
Yes. Customer globalization is their strategy to diversify the revenue base. They are making progress at a facility in Oregon, and they are actively trying to expand engagements with major global foundries outside of mainland China.
But right now, customer globalization is largely just an aspiration.
It is the #1 metric you must watch in future quarters. The pivot into new products like ECP and furnaces was successful.
We saw that in the numbers today.
Right. But the next required pivot is geographical. They have to prove they can sell these advanced tools outside of the mainland to truly de-risk the company.
Adding a layer of complexity to that risk profile is the insider selling data.
Always someone to keep an eye on.
Over the last 6 months, insiders executed 41 sales of ACMR stock and exactly 0 purchases.
0.
Most notably, CEO David Wang himself sold over $13.9 million in stock across 16 transactions. Other executives like CFO Mark McKechnie and Tracy Liu also sold millions.
We always have to caution that corporate insiders sell shares for many, many reasons. They have tax obligations, they seek standard portfolio diversification.
Right, buying a boat, paying for college.
Exactly. And these sales are almost always scheduled well in advance through pre-planned 10b5-1 trading programs.
Sure, I understand the mechanics of 10b5-1 plans, but the ratio still stands out. 41 sales to 0 buys over a 6-month period, while simultaneously touting a $4 billion long-term growth target, that is a data point that has to be factored into your assessment.
It's hard to ignore.
When you combine heavy insider selling with extreme geographic and customer concentration, it just demands vigilance from you, the outside investor, no matter how clean the operating leverage looks on the income statement.
The picture painted by this earnings report is one of a company executing perfectly on the things entirely within its control.
Right, managing product transitions, driving down fixed costs, capturing domestic market share.
But the things outside its control, trade policy, and the CapEx budgets of just 4 massive clients, those are what create the volatility here.
It is a really delicate balancing act.
Yeah.
You have this incredible 167% growth in the new product lines, supported by a billion-dollar net cash position, but it's weighed directly against the reality of exactly where those products are being sold.
The product mix shift proves they have the engineering talent. The real question is whether they have the geopolitical runway to fully monetize it.
Which leaves you to ponder a really critical question regarding the future of this stock. Can ACM Research successfully execute its customer globalization strategy to diversify its revenue before domestic China WFE spending cycles peak or international trade policies tighten even further?
That is the multi-billion-dollar question.
It really is. Make sure to follow this show for daily earnings coverage and deep dives into the market-moving reports you need to know about.